What if I told you that the foundation of the entire global financial system is quietly cracking right beneath our feet? Jaime Diamond, CEO of JPMorgan Chase, just issued one of his most urgent warnings yet, and the numbers he's pointing to should terrify anyone with money in the bank, a retirement account, or investments of any kind. Right now, America's interest payments on our national debt exceed our entire defense budget. Think about that for a second. We're spending more money just paying interest than we spend protecting our entire nation. And according to Diamond, who oversees $4 trillion in assets, we're about to witness something catastrophic in the bond market. But here's what makes this particularly alarming. It's not just happening here in America. Japan, once considered the pillar of global financial stability, has already seen their 30-year government bonds lose nearly half their value since 2019. That's a 45% collapse in just the past year alone, creating massive unrealized losses for their biggest insurance companies. So, why should you care about bonds? Because they're literally the foundation that holds up everything else. Your pension fund owns bonds. Your bank owns bonds. Insurance companies, mutual funds, and even foreign governments hold massive amounts of bonds. When bond markets start falling apart, it creates a domino effect that can destroy retirement accounts, banking systems, and entire economies. Let me break down exactly what's happening in simple terms. When you hear financial experts talk about yields or interest rates, they're essentially describing the same thing. The yield on a bond is just the return you get for lending your money to the government or a company. Here's the crucial part. When bond prices drop, their yields go up and vice versa. Today, interest rates are rising at the fastest pace we've seen in 40 years. The 10-year Treasury bond, which serves as the benchmark for most other interest rates, has jumped from less than 1% in 2020 to nearly 5% today. That's absolutely unprecedented in modern times. But why are rates climbing so aggressively? It comes down to confidence. When investors start doubting a country's ability to pay back its debts, they demand higher interest rates to compensate for that extra risk. It's like lending money to a friend who's always broke versus lending to someone with perfect credit. You'd want more compensation for the riskier loan. Here's where things get really concerning. America currently owes over $36 trillion, which represents about 124% of our entire economic output. Our yearly deficit is running above 6% of GDP, which is more than double what economists consider sustainable for a healthy economy. Recent research revealed something truly shocking about how we got trapped in this cycle. Historically, government deficits and unemployment rates move together in predictable patterns. During economic booms, unemployment falls, tax revenues increase, and deficits shrink. During recessions, the opposite happens as governments spend more to support struggling economies. But something fundamentally changed around 2017. Even as unemployment dropped to historically low levels, our deficit started exploding upward. Today, we're borrowing money at a pace normally reserved for wartime or economic emergencies, despite having relatively strong employment numbers. We're essentially spending like we're in crisis mode during what should be good times. This creates a dangerous trap. The more money we borrow, the more bonds we must issue. The more bonds flooding the market, the more nervous investors become about our ability to repay everything. When investors get nervous, they demand higher interest rates, which makes our debt even more expensive to service. Another critical factor is demographics. Baby boomers, the largest generation in American history, are retiring by the millions. The Social Security Trust Fund, which peaked around $3 trillion in 2017, is now declining rapidly and expected to be completely depleted within the next decade. For years, the government collected extra money from working boomers, but instead of investing it wisely, most of that money went into treasury bonds that barely kept pace with inflation. Now that boomers are retiring, the government must sell those bonds, back into the market to pay benefits, creating additional downward pressure on bond prices. The government faces an impossible choice: raise taxes, cut spending, or borrow even more money. Since no politician wants to do the first two options, we keep choosing door number 3, pushing us deeper into this debt spiral. What makes this situation particularly dangerous is that we've created what economists call a debt Ponzi scheme. Our entire financial system now depends on constantly increasing debt levels and continuous money printing just to function. In the past century, total debt in America has only decreased during 2 periods: the Great Depression and briefly during the 2008 financial crisis. We've been here before though. After World War II, America faced similar debt levels relative to our economy. Back then, the government solved the problem through financial repression, keeping interest rates artificially low while encouraging inflation to erode the real value of the debt over time. But today, we lack the tools that worked in the 1940s. We can't lower interest rates much further, we have concerning inflation pressures, and our demographics are working against us rather than supporting growth. So how do you protect yourself? Diversification across different asset classes becomes crucial. Consider allocating portions of your wealth across stocks, real estate, and alternative assets that can potentially maintain purchasing power during periods of currency devaluation. The key is not putting all your eggs in one basket when the entire financial system faces structural challenges. This isn't about predicting doom, but rather acknowledging that major economic shifts create both risks and opportunities for those who understand what's happening and prepare accordingly. And if you're concerned about how escalating global tensions could hit your bottom line, don't miss our previous deep dive video. In that video, I lay out the exact steps you need to fortify your portfolio before the next geopolitical shockwave. Hit the link on screen now or check the description to arm yourself with battle-tested strategies and stay one step ahead of every financial crisis.